Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. The case for a chat today with our guest, and let's get that case for a chat on the wall here. Our guest today is Abhay Agarwal of Piper Serica, and we're going to talk to him about whether domestic flows, can they sustain this market's uptrend? I think we've seen that trend for a number of days now. Can that continue? Financials, and we talk about whether lenders are hitting a bit of an air pocket, and therefore our non-lending financials, including insurance, pockets to look at. And after a really long period of time, can agrochemical stocks come back because they've had a very long winter? Are we likely to see some bit of a change there? I think all of those questions to our guest, Abhay Agarwal, Managing Director, Piper Serica Advisors, with us on the show. Abhay, great having you. Thanks so much for taking the time out. And you know, it's been a bit of a unbelievable rally, especially for people who have consistently thought that the markets have been expensive, and therefore it made sense to sit on a bit of cash, because it was not a wrong call from a judgment basis, just that the market has defied most expectations. How are you thinking about this up move that we're seeing and the levels that we're sitting at?
Yeah, thank you, Neeraj, first of all, for having me, and great to be chatting with you again.
Thank you.
I don't want to be judgmental about the market moves, because all of us have our own expectations about what the market should do. But markets have their own moods, Neeraj. You have seen a lot of it is driven by liquidity, both domestic and international. And there are times when most of the investors who are bringing in new money into the markets are driven by the near-term returns that their portfolios are generating, and they overlook the risks of a correction. I think if you look at it from 4th June, when the election results were announced, the markets dropped and the dip was bought into. The month ended 15% up. And then you had the budget, which had the surprise capital gains tax increase. And there was a very short-term blip, and again, it was bought into. So I think what is happening is that all investors who are chasing momentum are being rewarded by the markets. There's nothing wrong in it. I mean, that's what the markets do. And if you do a deeper dive and you look at the fundamental construct of the underlying economy, corporate earnings, clearly there is stress building up. There is some slowdown, short-term, medium-term building up. I don't think the markets are really taking that into account. The markets are going on their merry way, not only in India, but even in the US. All dips are getting bought into by the new money that keeps coming into the markets. A lot of it is driven by the expectations of a rate cut globally by all large central banks, making money even cheaper. So I think that is the market construct we are in. Very difficult to say how long will this rally carry on, because a lot of it is just driven by the new money that keeps coming into the markets, Neeraj.
Okay, so Abhay, there's this small story that we did, which was pointing out to the kind of flows that we've seen. Now, viewers, I just want to show you this chart before I go to Abhay on that, because while everybody knows that DIIs have been the driving force, it pays to look at what's happened to flows since 2021, Jan 2021. This is a stark contrast here. I mean, look at the quantum, 8,48,000 crores. FPI is 1,26,000 crores. And they have been actually putting in a lot of money in the current calendar in the primary markets, not so much in the secondary market. So Abhay, I heard you use the term that strange things can happen, not verbatim, but strange things can happen when liquidity is, gushing. Could we enter bubble territory as well? And will the market still continue to stay there if the domestic flows continue, Abhay?
No, I think in pockets of the market, Neeraj, we're already in the bubble territory by any meaningful valuation standards. You have pockets like PSUs, defense, railway stocks, very good companies. I'm not again taking a call on the quality, but it's just the valuations that we worry about as fund managers. That it is clearly a case of right now momentum money chasing near-term performance. And again, it is very difficult to take a call on where and how and when the party will stop. I think that sharp spike in the market driven by liquidity only stops when there is an unforeseen negative event, or there is a sudden drop in the market for whatever reason. I don't know again, but that breaks the momentum and then the cycle reverses. I don't know when we will get there. Right now is, the markets are where we are and we have to deal with them. We still have to find pockets of opportunity that are there. So I'm not so worried about, the markets being at an elevated level and at the valuations being stretched. I think, again, as we keep discussing, Neeraj, that there are bear markets going on even in bull markets. And I think as long as one can find opportunities there with a longer term perspective, you will end up making money in any kind of market.
Now, Abhay, the other piece is what's happening with, the underlying force behind any kind of GDP growth. GDP numbers came out maybe slightly below, but maybe partly anticipated. But when you look at the credit growth, is it pointing towards an issue, or is it that just looking at banks' credit offtake may not be the right way to look at it, simply because the street is not necessarily borrowing only from banks? I'm just trying to understand, how do you think of this and the bank's credit growth data that has come in from a growth perspective, and then from a financials perspective? Do you can therefore keep the banking exposure to a minimum, look at non-lending financials? Tell us how you think about this.
So Neeraj, I think the data actually, what has come over the last week especially, has been very consistently pointing to a slowdown. And this slowdown started about the time when RBI started squeezing or putting more risk mitigation measures for banks. They increased risk weights for unsecured lending by banks. They increased risk weights for NBFC lending by banks. Even for housing finance companies, the risk weights have gone up. Plus, a lot of constraints have come up on peer-to-peer lending. So as a result, what has happened is that the money has become not as easily available as it was last year for any kind of borrowing, especially on personal loans, credit card loans. Secondly, so that has led to that increase in cost of borrowing has led to a slowdown across the board in credit, and that number is showing now. Second, what that has also done is led to a demand slowdown at the Main Street level. So when we recently did our channel checks, we found to our surprise that there is absolutely no inventory buildup for discretionary expenses, discretionary purchases for this festive season. You have auto inventory, which is worrying the retail and the distributors. There is no inventory buildup in paints, in tiles, in other stuff that people would typically spend money on during the festive season. So clearly there is a demand slowdown for discretionary expenses, again driven by the high cost of money. And that is again reflecting in the GST data, if you saw, was up net of refund only 6.5%, whereas the government estimates were much higher. So I think GST data gives you a good idea of what is happening at the underlying consumption level in the economy. And if the GST collection slows down, that is a very solid hint towards a short to mid-term slowdown in consumption in the country. So I think these, and then you have the other issues related to banks, since you asked that. Our view on lenders, generally banks and NBFCs, is that there is the peak cycle of margins has been achieved probably 6 months ago. And now the cost of money, cost of deposits is going up. Deposits are more scarce to get. Cost to income ratio is going up across the board, we're seeing, because of higher rentals, attrition, salaries. And then you have higher NPAs kicking in. Collection efficiency has down from 98% to 94% for microfinance industry. So there is struggle on all aspects for lenders, including banks, private banks, public sector banks, and NBFCs. So in that environment, I don't see how for next 6 months or a year till the cycle reverses again in the favor of these banks, investors would expect to make money off lenders. I don't think there is going to be a multiple expansion, because the multiples are still the highest in the world, for our banks. So I think that is why we are negative on banks for the next 6 months to a year till we see again the margins going up. But right now we don't have any visibility of that neither.
Okay, and therefore, Abhay, then my counter question is, so you don't have to keep a exposure to financials, but or non-lending or lending, but are you exposing yourself to non-lending financials? There is insurance. There's also the wealth managers, which seem to be doing well on a quarter-on-quarter basis. The numbers are looking solid. Do you like the non-lending space?
We like the non-lending space, Neeraj. So I think there are three bets that we already have there. One is, which has been with us since post-COVID, which is what we call capital market infrastructure players, CDSL, CAMS, Angel One, because if the capital markets have to grow, which they will grow, these companies make a lot of money just, because they're basically tech companies that are benefiting from the macro investment theme. So, and these CAM, CDSL, Angel have already done very well for us, so, and we continue to hold them as per our model portfolio allocation. The second part is, which is more recent, about 6 months ago, is the insurance players, because we saw a long sideways correction in health insurance companies, in general insurance companies, and in life insurance companies. And after doing a lot of research, we finally placed our bets. And this is not by recommendation, but our model portfolio is known in the market. So we have ICICI Pru, ICICI Lombard, and Star Health in our portfolio, because we think that this is a space that has been ignored by the investors, and finally the regulator is getting more friendly. There will be launches of more innovative schemes, better risk coverage, and the valuations are quite attractive again by historical standards. So looking at that, insurance is a space we are quite bullish on. There are near-term triggers, reduction in GST. We are hoping it happens, but we are not banking on it. If that happens, I think the whole space will re-rate pretty quickly. And the third, as you said, is the wealth managers. I think that is a space, again, that will grow pretty rapidly. Valuations are a little unattractive right now, so we'll probably wait for better valuation levels to make a bet there.
Interesting. Okay. So, well, that's the sense of the broad structure view on the largest sector, which is financials. Now, move on to one of the other larger sectors, which has got a news flow to itself. So, let me get in my colleague Mihika to talk about the development today, or the development over the weekend, wherein the board of Gujarat Gas and Gujarat State Petroleum announced a scheme of arrangement which will consolidate these entities. The holding company structure collapses. Maybe that's what's led to this uptick here. But Mihika, tell us very quickly, one, what does this mean for the console entity, which is Gujarat Gas, because it now becomes a different business, and what is the brokerage view here?
Good morning, Neeraj. I'll break it down very simply. There are two parts to it. First part is three companies: Gujarat State Petroleum Corporation, Gujarat State Petronet, and JSPC Energy will merge into Gujarat Gas. So now, post this merger, Gujarat Gas will be, in the business of city gas distribution, gas trading, exploration, and production. And after this, the transmission business will be carved out separately and demerged and be listed as a new entity as called JSPL Transmission. Now, in total, Gujarat Gas will have to issue a 78.66 crore new equity shares, but 53.7 crore shares will be extinguished because all the companies involved do have promoter stakes in each other. And like you said, there will be a significant drop in terms of promoter shareholdings for both these companies. And this entire scheme is expected to be completed by August of 2025. In terms of valuations, where Gujarat State Petronet is valued at 26,000 crores, but the core business is only valued at 3,500 crores. Gujarat State Petroleum Corporation, on the other hand, is valued at 21,000 crores, and the implied EV to EBITDA multiple is at 7 times, which is in line with industry standards. In terms of brokerage views, well, most of the brokerages have highlighted the same thing. One thing, let me start by Jefferies. They've maintained an underperform rating. They've said that the integration of everything will improve Gujarat Gas's margin profile, but it can increase earnings volatility for the company. And they've stated that the fair value of Gujarat Gas post the merger, according to the calculations, comes to 513 rupees per share, which implies a 15% downside. And in terms of MK, they've also said that they expect the merger to imply a 50% EPS accretion for Gujarat Gas. So that's what we have on that, I think.
Okay, Mika, thanks a lot for putting this into perspective. Abhay, how do you view some of the developments in the oil and gas space? I mean, one, crude is doing what it is doing. Two, this recent development of this companies getting collapsed, and if you have views on maybe Gujarat Gas or the CGD players, if you will.
No, we have always liked CGD players, Neeraj, because I think this is gas, natural gas is the future, and pipe gas especially. From a customer perspective, Neeraj, you and I use gas at home, and there are industries that use, gas, and getting it through a pipeline is so much more convenient. So there is a clear customer move towards having it. The rollout has been slower than what people would like to be, but I think where there are incumbents who have already taken a leadership position in their local geographies, I think this is a great business to be in, because over a period of time, gas prices will only continue to trend up. It is a far cleaner fuel than others, easier to transport. So we have a very positive view on city gas distributors. And generally on the oil and energy space, I think this is a space that will be, that is already being looked at with a lot of interest by the government to make sure that India is not dependent on only oil imports all the time, but to create energy security for the country. So I think there will be big rollouts in terms of renewable power, in terms of power distribution. And again, as I said earlier, it is better for investors to bet on the big names, that have the balance sheet strength to carry off these big projects. So definitely very positive on the entire power and energy space, Neeraj.
Okay. Okay, the other one, Abhay, and moving on from oil and gas, is autos, because the auto sales numbers have come in. I heard you mention that something around the inventory and the demand slowdown, but we were talking to M&M, and M&M mentioned that at least in the SUV end, the inventories haven't quite built out. So it was actually pure sales that led to the uptick that they saw, and they seemed confident about the rest of the year. So are you in general negative on autos currently? But could there be pockets, like maybe an SUV player, maybe two-wheeler companies, because I think the expectations, the TVS performance was pretty good. Could there be exceptions to autos, or is autos best avoided?
I think in the and M&M could absolutely be right. I won't argue with them. They know data better than we see, because we do it from our channel checks. And when we did the channel checks, we didn't really dive into category-wise inventory data, Neeraj. It was more to understand the mood of the distributors, the mood of the showrooms. And there seems to be some concern that the inventory that they have right now is the highest over last 4 years since post-COVID. And the sales have been slower, the inquiries have been slower than what they're used to in a pre-festive season. So there is a worry that if the sales and bookings don't kick in, again, there is an expectation, Neeraj, it may change, post-Shraddh period and everybody gets into the buying mode. It may change pretty quickly. But what we saw right now is that the distributors are quite cautious about asking the OEMs to send them more inventory. I mean, in fact, the message is clearly, do not send us more inventory. We have enough inventory. I saw a report from one of the automobile financing companies that clearly said that, look, it is 72 days of inventory that the dealers are carrying, which is probably the highest post-COVID environment. So I think in that environment, better to wait for the festive season to get over, see the actual dispatch numbers from the OEMs to dealers in November to get a good sense of which way it is going. Because if the demand doesn't come back, then the worry is that you will see a pretty conservative guidance and drop in quarterly earnings, which may negatively surprise investors in auto space. So I would just say that it's a very good long-term theme, but in the short term, maybe better to be cautious, wait out till November and December data.
Got it. Now, Abhay, because I was reading your newsletter and because you mentioned out there, right, that some of the pockets in the markets are now even beyond frothy. In fact, I was looking at one of the charts tweeted out by a fund manager, which showed that the P multiple, aggregate P multiple of the top 500 stocks, and what percentage of stocks are trading above 50 times PE multiple? 50%, more than 50% of the stocks are trading at a PE multiple greater than 50, which makes the market very expensive. So Abhay Agarwal, my question to you is, how are you building out your portfolio as aggregate currently? What kind of stocks are you choosing? And are you sitting on cash or are you fully deployed?
Neeraj, we are being very defensive. Again, let me put a disclaimer here. We are very, very bullish as anybody who believes in the India's long-term growth thesis. If you take a 5-year call, if you take a 10-year call, I don't think any market in the world will create the kind of returns that India would make for long-term investors. Having said that, there are times when the markets get overvalued. There are times when markets are undervalued. And that's a cycle that the markets go through. And as the data you put out, Neeraj, and I think you and I and the fund manager are one of the few people who's actually looking at PE multiples. Right now, everybody is chasing short-term performance. But what we are doing at our portfolio level is that we are just being more defensive. And to become defensive, what we have done is, first of all, we have looked at the portfolio level valuation. And at a portfolio level valuation, we want to be below 25 times PE multiple. Because if the market's correct, the expensive stocks correct the most first. So we have made some changes to the portfolio, taken out some stocks in the portfolio that we like. The companies we like, will probably add them back at the right time. But they were trading at a multiple of more than 100 times, which we find it difficult to justify in a slow growth environment. Secondly, we have increased cash in the portfolio to about 20%. This is a temporary call. It's not, when we find opportunities, we'll definitely deploy. Third, we have increased the weight of large caps just because, the large caps that are not the expensive large caps, but are still growth stocks at available at an attractive valuation for the growth that they're getting into, so Hindalco, Grasim, these kind of companies. So these are the three things we have done, Neeraj. The returns have been very robust over the last couple of years. So we just want to protect those returns right now. I think the next 3 to 6 months will be very choppy for markets globally. A lot of trigger events, rate cuts, election results. Even in India, there are 3 states that will go through elections. So I think we just want to wait it out, and we have a buy list ready. We will use the cash in the portfolio, as we get opportunities.
Okay, so defensive portfolio, a bit of cash. We'll use the cash when the opportunity arises. That's the summation of the portfolio construct. I have a question, Abhay, 2 questions before we wrap up. One, that I don't see an IT service name in the portfolio. And please correct me if I'm wrong. Why is that the case? We are closer to November. There's a lot of talk of how post-November there might be clarity. We are closer to a rate cut cycle. Usually that's augured well for the tech businesses too. Why no IT service stocks?
We have been underweight on IT for last 1.5 years. From January last year, we don't have any IT stock in the portfolio. The reason for that, for the IT services exporters, Neeraj, is that when the management itself is guiding for 1 or 2% or 3% growth over the next year, I don't know why we should pay a multiple of 25 to 30 times or even more just because of the optical defensiveness of earnings. I mean, investors get rewarded for betting on growth and taking that risk. But if the management itself is guiding for a flat to no growth, I don't want to second guess the management and say this company will actually grow faster. So one is from the valuation perspective. The second is from the perspective of the market dynamics and the product offerings. I think a lot of these companies are right now under pressure from newer technologies, especially AI, ML, that is taking away large parts of the fixed cost projects that they do. The whole dynamics of pricing is changing even with large customers. And if you look at their large banking financial services customers, JP Morgan, Wells Fargo, Citibank, they have their own cost pressure. So it's not that if the rate cuts happen, the bank starts spending a lot of money and all these contracts will come to the companies. There is going to be a lot of pricing pressure, lesser, very large value deals. Even large value deals will have lower margins. So I think in that environment, I don't see why we should jump in and add an IT services company to our portfolio. We are looking at IT product companies, which we find to be interesting in case they are focused on a particular vertical or focused on a particular new technology. We are considering them, so maybe we'll add them to the portfolio, but definitely staying away from large cap IT names right now.
One final question, Abhay. Bunch of IPOs out there. Anything exciting? Also, this Bajaj housing finance piece, right? And what implications could something as large as this have per se, because it's from the financial space? It may mean that Bajaj Finance now starts trading with a holding company discount with regards to that business too. Quick thoughts here. We have about a minute and a half.
Yeah. No, I think some of the IPOs that we've seen are very good IPOs, Neeraj, and that gives me a lot of confidence that we are not in that bubble zone as far as IPOs are concerned. The valuation is interesting, attractive. I would say the business models are attractive, and I think it's good that these IPOs are coming in, giving a lot more breadth and depth to the market, and giving the mutual funds and investors an opportunity to deploy the cash they are sitting on. On Bajaj Finance per se, I think it's an interesting one, very large player, and is good. Again, investors are getting an opportunity to invest in a large company like this. What happens to Bajaj Finance share price because of this listing will be an interesting one. I don't know how it will react. There could be some holding discount element there. But I think to have this company list itself, I'm happy because it gives investors a bigger opportunity basket to invest in the housing finance space.
Got it. Okay. Abhay, so good talking to you as always. Thanks for taking the time out. And I guess we're in the build up to the festive season. We'll see you around one of the big festivals or maybe more. But thanks for taking the time out today.
Thank you, Neeraj. It's my pleasure to be on the show.
Thank you. And with that, viewers, it's a wrap on this leg of Talking Point. Thanks so much for tuning in.